Welcome to another edition of Forward Guidance. I'm joined by Joseph Wang at fedguide.com, as well as Martin Pelletier, Senior Portfolio Manager at Wellington Altus Private Counsel. Gentlemen, welcome. Great to have you here.
Great to be here.
It's a pleasure to be here, Jack, and it's great to see you again, Martin. For those of you who don't know, Martin has decades of experience, very, very good asset manager, very good track record, and he's also an influential voice in the Canadian financial community. He writes a column at Financial Post, and he's been doing that for decades. So we definitely want to hear what he has to say.
Decades, certainly I need a little bit more gray hair.
There we go. So, Martin, I want to ask you, what was it like to invest last year at a time when central banks were raising interest rates? A lot of my viewers will be familiar with the experience. Oh, is the Fed going to do 25? Oh, no, 50, 75. But at actually managing, other people's money, that classic OPM phrase, what are the things that people might be missing if they're just sort of, reading the Wall Street Journal and not actually, managing money?
Well, there seems to be a little bit of a comparative bias. So what I mean by that is a lot of managers, when their markets are correcting, they'll relay on that, hey, it's just the market dynamics, and we have to participate with it, unfortunately. And so just buy and hold and ride it out seem to be the pervasive advice. Whereas we're active risk managers, these are the years that we shine. And people really don't give credit as to the value of downside protection. There's something called risk parity. And so if you could prevent losses, it goes a long ways to achieving your objectives as an investor. And so, like, if you lose 50%, you got to double your money to get it back. And we seem to lose sight of that because everyone was so focused on the huge gains in 2021, especially in the long duration segments of the market, which gave back a lot of those, or if not all of those returns last year. And so it was a year that we worked really hard, but we protected almost all of the market downside, even for the traditional 60-40 investor.
How are you weighing the risks in 2022? What was the risk in 2022?
Well, the risk was duration risk, and so many people miss that. If you ask any portfolio manager, and I did ask some fellow fund managers and very well known fund managers what the duration exposure was on the equity side, the look I got back was quite shocking. They didn't know, it wasn't being measured, and the reason why is we had a decade of managers being rewarded for extending the duration exposure, right? And rightly so. I mean, we were in a low interest rate environment. You had low unemployment. You had the perfect sweet spot of a scenario for these investors. And then you had asset inflation caused by these low rates. And so they were rewarded for taking on that equity duration, whether they realized it or not. And they were being told, and maybe they were telling themselves that as well, that inflation was transitory, just as the Fed was, and it wasn't. And they got hammered last year, both on the fixed income side for the balanced investors and on the equity side. And you can see that. You can pull up the TLT, for example, 20-year treasuries, or pull up the triple Q. Pull up both of those charts over last year and overlap them. You'll see that they mirror themselves perfectly, with little gaps where the equity duration speculators are keep trying to call a Fed pivot, where the bond investors are saying, we're not there yet. And so we have these head fakes that we've seen. And so I think there's that mentality. And then now we're going back to the mentality that, as I've heard, the immaculate disinflation by Bob out there, and talking about how we're going back the way it was and reloading those duration bets.
Right. Joseph, could you provide a definition for our audience of duration, which has a very rigid definition for bonds? And then could you apply it to equities, where I think it's intuitively it makes sense to apply to equities, but I know it's quite hard to apply it, sort of mathematically to equities. And would you agree with Martin that duration was the main risk of 2022, and does it remain a risk as you see it?
Yeah, so that's a good point. So duration is basically interest rate risk. So let's say how much does your portfolio change with a 1% shift in 1% change in interest rates? So as a rough estimate, your duration risk is in proportion to the size of your coupon and the tenure of your assets. So if you have something that's maturing in say 30 years with a very small coupon, then that asset is very sensitive to changes in interest rates. And small changes in interest rates can make that asset decline a lot in value. In fact, if you look at say the 30-year U.S. Treasuries, it declined a lot during the past year, basically giving you equity-like performance, even though supposedly it's a very safe asset, U.S. Treasury. So for bonds, even though there's no credit risk, you have a lot of duration risk. And when people look at equities, they sometimes think of equities that have cash flows that are far out into the future to be similar to bonds, long duration bonds, because you don't get like a 30-year bond, you don't get your money back in, let's say, a stock that doesn't make money until far into the future. So in a sense, the cash flow profile for, say, a tech company that makes no money today, but you imagine it to make a lot of money sometime 20, 30 years from now, the cash flow profile could be very similar to a long dated US Treasury. And so if you use that framework to look at these equities, well, usually they're tech equities, then you can think of them as moving the same way as fixed income, long dated fixed income does. And so last year, when you saw the US Treasury market, suffer significant drawdowns, you also saw these tech stocks also take a big beating. And I don't actually know if that it makes sense to think of equities, say tech equities or money losing tech equities that way, but that's how the market has kind of agreed to think of them. I think going forward, I agree completely that there's still interest rate risk. One of the things that I've noticed is that the market always thinks that the future looks like the past. So, as Martin was suggesting, many people are thinking that we're just go back to the low interest rate world that we had before COVID. So they're loading up on bonds, they're loading up on tech equities, and so forth. But sometimes the future does not look like the past. Now, usually, if you look throughout history, if you have that framework, that simple framework where the future looks like the past, for the most part, you'll be correct because the world really doesn't change that much. But at turning points, though, you get caught off guard pretty significantly. And we saw that after the GFC, for example. After the GFC, the market kept thinking that we'd go back to hiking rates as we did before the GFC, but we didn't. And so the market was wrong for a long time. And today, the market thinks that, the post-COVID world looks like the pre-COVID world, so we'll go back to cutting rates, and you got to buy tech, you got to buy bonds, and so forth. And if we have a structural shift, it looks like the market and everyone who thinks that way is going to be wrong-footed again. So the market is really not good at predicting the future.
Business models and companies who thrived at a period when interest rates were zero, that now that interest rates are between 4 and 5%, the math just doesn't work anymore. Could you describe what types of companies those are? And Joseph said tech companies, growth companies, but I'd love a little more color.
Well, the best way is to look who's actually laying off staff and where the layoffs are coming from in this environment. And so, you had a situation where you threw out discounted cash flow analysis out the window because, when you had 0% interest rates, the numbers were huge. And now they're being asked to deliver cash up front instead of at some promised date, whether it's 10 years or 15 years or some big growth. So the only way they can do that is by cutting staff. And so look at the layoffs. Just pull up the charts, and you can see most of those are within the tech space, even within the FANG space. But you have the S&P index that you have 5 companies that are 25% of the earnings of the entire index. And so, there's some important takeaways. If you're a passive investor, we've been told that, just go passive and you're going to be okay. Well, if you're passive in the S&P 500, you've got 5 companies that are 18% or 19% of the index, which is as high as it was back in the tech bubble. And so you've got a high concentration to those kinds of companies that are, as Joseph explained, high growth, long dated cash flow. And now they're trying to front end load that cash flow through layoffs. And I think it's very important to be cognizant of that and what you own.
So, Martin, most of our guests are U.S. based, but you are based in Canada and specifically in Alberta. What are things looking like in Canada right now?
Yeah, looking at Canada as a whole, it's a really good place to be. I think Alberta is very much an inflation protected area within North America or even globally. And the reason being is because of our resource exposure. And resources are an excellent hedge. For every 1% gain in inflation, oil prices and oil energy related prices will move up 8 to 9%. And so you've got a built-in hedge there, and so that's working out really well. Now, from a Canadian perspective, because of the low rates, investors have gone into real estate, whereas in the U.S. it went into technology. They've been exiting that trade, with the exception of Alberta. Actually, we're seeing. I've been to a couple of open houses, for example, packed with people. Houses are selling at or above a list. People are feeling really confident that the Bank of Canada is going to pause, like they potentially indicated towards, depending on your interpretation. And then you've got energy as well. So we're a little bit of, I have to be careful because we're a little bit of it in a safety pocket zone here in Alberta.
I have a question, but so for Canada, for the asset management industry in Canada, is it mostly like when you guys invest in equities, is it often in U.S. stocks? Because I know Canada, of course, has its own stock market and so forth, but it's also right next to U.S. Now,
Yeah.
for people based in the U.S., we basically just think about the S&P and what's here. But how do things look from the Canadian perspective? Is it just very common to also invest in stuff like the S&P 500 and U.S.-based companies, or is there kind of a preference for things that are listed on the Toronto Stock Exchange?
So Canada as a whole, it's only 2% of global GDP. I think California is similar in size, maybe a little bit bigger to all of Canada. And so we tend to think we're bigger than we are. Well, we are big, but from a landmass perspective, but not from a population side. But looking at a GDP component, it isn't that big, but it is significantly larger in Canadian portfolios. But that has been changing over the last decade because the top asset managers, as you know, performance sells, and the top performing asset managers were those heavily weighted towards the U.S. and weighted towards U.S. tech, for example, and very small weight into resources. We saw a structural shift in the market in 2008 with quantitative easing coming in post that. And then 2014 was kind of a big death knell for energy with OPEC targeting a price war against U.S. shale producers, which got Canada caught up in that as well too. And so if you had a strong weighting to the TSX, which has a larger weighting towards energy, you underperformed significantly. And then you had the U.S. dollar appreciation against the Canadian dollar. So don't forget, I mean, we were at par. Actually, we were above par for some time. And so you add that into the mix, it resulted in significant underperformance. And so there was a big hurting towards performance chasing and the S&P. And now we're wondering, if that's going to continue to be the case, or we go back to where it was post the bursting of the tech bubble when the TSX outperformed the S&P, not only just from an absolute basis, but also from the currency basis with the Canadian dollar rallying.
So, for example, if you were a Canadian fund manager and last year you bought into the S&P 500, you would have not done well, but you would have actually made money on the appreciation of the dollar if you didn't hedge your currency.
Yeah.
How big does these FX impacts, I guess, shape your decision to invest in the U.S., or is it usually on a FX hedge basis?
So we do hedge. We'll look at, so for example, our S&P exposure or U.S. equity exposure, More recently, we've been doing CAD hedged because we think the Canadian dollar will hold up well compared to the US dollar. And so we want to factor that into the equation. If we're going to head into a deep recession, as some of the bears are saying, then you probably want to have more of that U.S. dollar exposure than the Canadian equity exposure, Canadian dollar exposure. But we don't see that being the case, and it can be quite material in your returns. Like you look at Japan and the performance. If you're a Japanese investor, and despite the huge sell-off in the S&P, the currency appreciation against the yen resulted you being, I think it was positive last year. And so currencies, when you're having these central banks, big movements in rates, it's very important to understand.
Yeah, for sure. Like if you're a US based investor, you never think about this. But for everyone else in the world, and everyone else in the world is very active in US assets, there are two layers here. You can make money on the currency, even if you lose money on the underlying asset, like you mentioned, Martin. One of the interesting things that happened in Canada over the past few years is that Canada joined the QE bandwagon and is also joining the QT bandwagon. That was a bit different from the Fed, which has been doing this for some time. How is the Bank of Canada's QE and QT program being perceived in the financial community there?
I personally believe, if you look long term, that the Bank of Canada follows the Fed. It has to. It's just because our economies are so linked to each other with trade, and so you can have the luxury of not following the Fed when you have strong resources, for example. And so you can have a higher Canadian dollar when you have the higher energy prices, for example. And so I think there's more recently been a disconnect between that relationship. And so what I mean by that is energy prices have been moving higher, and the Canadian dollar has not maintained its historical relationship. So it should be higher given where energy prices are at. And that's simply because there isn't a lot of projected capital going into the energy sector. So typically, when you saw the last cycle, you saw, when I was on this, for way of background, I was an energy analyst for 10 years on the sell side. And our biggest capital providers were China and US. And there was a vast amount of capital coming into the country. And so that was very supportive to the currency. And that's not happening today. That capital is not going into the expansion. It's just globally and domestically, there isn't an appetite for expanding traditional hydrocarbon expansion. So I think that's why we're seeing a little bit of a disconnect.
Martin, since you mentioned that, we got to get your view on energy. I mean, if you look at, so it depends on what index you look at. If you look at WTI, it seems like it's just kind of bouncing around for the past few months. And I think in Alberta, it's Western Canadian WCS, I guess.
Yeah.
So what do you think is, I mean, so heading into this year, you had a lot of people talking about, supply problems with energy. And last year, you even had concerns about, because of the geopolitical events in Russia, that we might have not enough energy. Fast forward to today, it seems like recession calls are getting weaker. The economy seems to be strong, and yet energy doesn't seem to go anywhere. Do you have any thoughts on what might be behind that?
So I call the energy trade the most hated trade out there. It's almost like big tobacco, or it's becoming like that. And so that in itself creates opportunities for those who want to invest in the segment itself. And looking at it from a philosophical standpoint, we need those traditional energy development in oil and gas to bridge the gap towards renewables, which I'm totally supportive of. However, that said, in my entire career, I have never seen such a precarious situation on the supply-demand imbalance. And people keep saying that we're at peak demand, and demand keeps going up higher and higher. And at the same time, you're having this variability, as you just mentioned, Joseph, in pricing. And if you're an energy company and there's no capital coming in, there's no appetite from institutional pension plans, for example, who's divesting of assets. There's no capital availability, and you're having tremendous volatility in the underlying. I mean, you're a price taker, So there's tremendous variability in that pricing. You're not going to put a lot of capital back into the ground. And that's not just in U.S. shale. That's also in other countries, like big OPEC producers like Saudi Arabia, for example, who have been tapping into the reserves and global inventories to meet the surge back in demand. And so those global inventories have been depleted. And even the SPR, we're back to March of 1985 levels. And that's when we were ramping up the SPR. And so you've got this potential situation setting up for a big supply and demand imbalance. And I really hope, and weighing against that is the recessionary worries, which is actually good, because the last thing I would want is to see energy prices super spike to $150, even though I'd make a ton of money off of it in the short term. In the longer term, it could create some damage that or to our battle against inflation and other aspects.
So we seem well supported where we are now for the past few months, but it doesn't seem to be doing the price of the, I guess, oil futures don't seem to be doing much.
No, and there's a disconnect between the paper traders and the physical market. And paper traders, which are a significant component of that market, are being a lot more bearish than the actual physical market that's transpiring. And so if there's an event like in Russia, for example, that would result in 500,000 or a million barrels coming off, that would be a catalyst to super spike some of these prices. And if there isn't an economic, like we're not seeing if you look at you follow this more than I do, but looking at PCE data, look at consumer spending in January was insane. Traveling, people are still spending money, and the economy is still strong, and that's going to translate. We get into summer vacation and driving season. You have China reopening with flights and people being cooped up in China, and they start doing the YOLO, you only live once, and they start doing what our baby boomers are doing in North America. Then you're going to get a surge in demand, and the supply just isn't there to meet that demand. And so you could see what energy prices and oil prices in particular spike. Now I'm saying oil because it's important to make the distinction between that and natural gas, because natural gas is a much different scenario right now from a supply-demand fundamental standpoint.
Martin, isn't it the case that in China, demand for jet fuel and other refined products is actually only a small fraction of the demand for total oil, and most of the oil demand in China is from refineries to produce
Yep.
refined products for exports. And I've heard that those refineries were operating with very high throughputs all throughout the pandemic, even during zero COVID. And there's this thesis, you probably have encountered, that a reopening in China might not be as bullish for global oil demand as one might think. What do you think about that?
I think it's just a time delay. So you're not going to see it up. You're not like you just described. You're not going to see it in an immediate impact, right? But the longer it stays open, the greater the situation plays out that they deplete some of those inventory builds from the refinery runs, and it proves to be sustainable. You pair that with actually the biggest growth that we're seeing is out of India, and India is really getting my attention. I met with a fund manager who's looking at expanding an Indian fund here in Canada and the US. Like India is really I was there back in 2003 or 4. I was really impressed with what was happening then. And now it's just really taking off. So I think India could be potentially the new China. And what does that mean for demand?
Tell me about natural gas, because the price absolutely exploded last year, but since then it's fallen precipitously from its highs. And I'm just looking at American natural gas producers. Their stocks might be down 40 or 50% from the highs, when the actual commodity is down something like 80 or 90%. And a lot of these companies are not making money. They're actually losing money at the current prices. So the B word is a dangerous word, but might there be a bubble in these natural gas only, not oil, but only natural gas companies that, they're the only way they make money is the price of natural gas goes higher, which is pretty wishful thinking.
Just for context, guys, natural gas futures went as high as almost $10 a few months ago. Now it's like $2.50. So like Jack mentioned, it really took a dive.
Weather really played a huge part in Europe and in the U.S. We've had that. Now, for listeners, I'm an avid skier, and so I do follow the weather quite closely. And this has been one of the most challenging ski seasons that I can remember. The snowpack this weekend is probably the same as it was in November, December. And in some places in Europe, my son's a competitive skier. His colleagues or teammates, sorry, are saying that there's green patches in some of these ski hills. And so we've had a really warm winter, and that collectively saved Europe's bacon, and it also did with the U.S. And so you had a situation where inventory and supply was rapidly able to build out, and because of that big drop in demand. Now, who knows what the weather is going to look like next year or the year after? And so I don't like investing based on weather. It gets to be too difficult to look at. Now, are these not long-term gas prices sustainable? Probably not. Looking at where they'll normalize or mean revert is probably higher. And so energy stock investors are always hedging their bets a little bit. So what I mean by that is if you own an oil company, they're generating tremendous cash flow, and so they were reflecting a $50 to $60 US a barrel oil price when the oil prices were $100 a barrel. And then so when you saw the oil price correct, these oil stocks didn't move down as much this year. So everybody was highlighting that gap and saying, well, oil prices are down, these oil stocks are not down as much, you should sell that. And I'm just saying, well, let's just back things up a little bit and look at 5 years instead of 1 year. And then you'll see that the gap really isn't that wide. And so I think the same kind of situation is playing out for natural gas and natural gas producers and natural gas stocks. And I'm actually looking at natural gas stocks, even though you're right, some of them are losing money, but low cost producers are able to sustain themselves through this environment. And then they have huge torque upside when natural gas prices recover. And so I'm not there yet, but I'm seeing some best in class up here in Canada, some best in class, and I know the plays that they're invested in. There's some best in class companies up here that are trading significantly lower than they were 6 months ago.
Right. And Martin, when you said that there's still underinvestment in energy, and I feel like in the US, if you look at XLE, as you mentioned, that index of large cap American oil producers has been rising, and companies like Chevron, Hess, ExxonMobil are they're pretty much close to their, if not all-time highs, their 5-year highs. However, it's a lot of the Canadian producers have sold off dramatically. Are you finding more value in the Canadian producers? And then how would you assess just the quality of businesses of Canadian oil producers versus American ones? Like, what are the differences, and to what degree are they positive or negative?
Good question. And so we've had a lot of consolidation in Canada among the producers. And so we have higher vacancy rates downtown Calgary than other places. It's like 30% vacancy rates. And we've had a tower called the Nexon Tower that's I think is 45 floors, is completely empty. And so the tie into the Canadian producers is that we've consolidated, and so there isn't as much competition, and there's a lot more control over pricing. And so their operating costs are quite low, so they can make money in a lower priced environment for longer. And then there isn't as much competition, so as a result, they can secure some very excellent position, world-class plays in the Western Canadian Sedimentary Basin that the U.S. producers have left, for example, and international players have left. And so they'll have land dominance, a huge inventory to drill from, and excellent well economics. And then you've got the currency. So these producers get paid in US dollars and their cost base is in Canadian dollars. And so if the Canadian dollar stays where it's at, so don't forget, we were at par before with the currency. Now we're not. And so these producers are getting paid in US dollars and their cost base is in Canadian dollars, which is lower. So they have even larger margins. So we're sticking close to home. We will pick away at a couple of international players for diversification, but for the most part, there's some outstanding companies right here in my own backyard.
Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world. And this year, Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and Permissionless is something you might want to attend, what I'm saying is there's no time like the present because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview. Martin, returning to the Bank of Canada, how sensitive is the Canadian economy and Canadian financial assets, stocks, bonds, everything, to rate hikes? There were a lot of folks in America who were saying, there's no way the Federal Reserve can hike to 3% because the economy can't take it. But it proves that the American economy has been, at least so far, much more resilient to rate hikes than many people expected. Is it somewhat different in Canada? I know in Europe, there's a lot of variable rate mortgages where, mortgage payments or rates go up with rates. Mortgage rates go up with interest rates, whereas in the U.S. it's a fixed rate. What does the environment look like in Canada?
Now, I had a really good conversation with Joseph about this, and I really remember it quite well about 30-year term mortgages and how the sensitivity to rising rates isn't as strong as it would be in Canada. Most people in Canada, we have a 5-year. Most people go 3 to 5 years terms, and so there's a little bit of a lag there in regards to having the impact on the average Canadian. But we'll probably get there a lot sooner than the U.S. So because we're only 1 year into that. So if you give it another year of even maintaining rates, that's going to have an impact. And so we're seeing, just from what we're witnessing, we're also our economy is a lot more sensitive to interest rates simply because we've gone all in on real estate. And there's a number of different reasons for that, but immigration is being one of them. We have one of the loosest immigration policies internationally, and from the existing government. And so we're having 500,000 people come into the country, and there isn't any housing for them, despite the landmass, because they're going into big cities like Toronto and Vancouver. And actually now in Alberta, we had 55,000 people come into the province last year, and half of them were international, half were from other provinces. And so there isn't the supply of houses, and so people have been making a lot of money on speculating on real estate. And real estate is actually a significant component. I think it's 12% of our GDP versus I think it's 7% or 6% US. And so we'll have more sensitivity there simply because of the shorter term and the greater impact on the economy. And so there's been a surge in housing now because of the Bank of Canada's latest statement. Everybody's thinking that we're going to see a rate cut in the second half of the year. And so it's time to go all back into housing. Same thing about what the US investors are doing on tech. The Fed pivot, Bank of Canada pivot. They're just playing it through real estate.
I'll give some context of those numbers just for a little bit. So Canada is about the size of California, and they're getting about 500,000 immigrants a year. The U.S. is obviously much, much bigger. The US gets about 1 million legal immigrants a year. So, the immigration rate in Canada is just huge, huge, huge. And that can obviously put upward pressure on housing.
Mm. Thanks. So the Bank of Canada is hiked to 4.5%, pretty much exactly in line with the Fed, whereas the Fed's 4.5 to 4.75. And there's been rumors of a Bank of Canada pause. And once the rumors of the pause come in, that gives way to rumors of a cut coming in. So what's the vibe like in Canadian financial markets about where the forward rates are going to go, and how does that affect sentiment and asset prices right now?
And so the pervasive thought among consumers is that rates are going to stay where they're at or fall back down again. And then you have had a drop in housing prices in some of these cities like Toronto and Vancouver, like 25, 30%. Now that was from the highs. Don't forget, if you back it up again, you expand your time horizon, it's not that much of a drop compared. It flat from where it was 2 years ago. So all of the excess from the COVID startup again has been gone. And so again, as Joseph had mentioned about investors in the U.S. going back to thinking that we're going to be back in 2020 terms with asset inflation with tech stocks. The same kind of thought is here in Canada in the real estate market that we're going back. And so all I'm saying is just exercise a little bit of caution. Look at your sensitivity to interest rates and run the numbers so that if they stay where they're at, even if they hold, I don't think people are saying they're thinking they're going to hold. I think the pervasive thought is they're going to drop. But if rates stay at 4.5 for 12 months, what does that mean to your balance sheet? And can you sustain that?
So for I think a few years ago, mortgage rates in Canada are about 1%, right? So you have basically, if you have to renew your mortgage every 4 to 5 years, that means basically 20% of the people are getting this huge interest rate hike from 1% mortgage and renewing it to 4%. So that's a big jump. In Canada, are mortgage interest deductible, tax deductible, like they are in the US?
No, they're not. But there's no capital gains tax on when you sell your home, and so people have made a ton of money on house flipping. Millions of dollars. Houses that 5 years ago were $800,000. People are selling them for $1.5 million now, and so there's that against the against the lack of deductibility of your mortgage.
And Martin, what's your economic outlook on Canada, but also the U.S.? Do you think we are headed for a recession sometime in late 2023, sometime in 2024, or not at all? Maybe start with Canada and then perhaps go to the U.S.
So it's important to start off by making the distinction that an economy and the outlook for the economy doesn't necessarily mean the same kind of relationship in the stock market. You can see some differences there. And so what I mean by that is I'm bearish on the Canadian economy versus the U.S. economy. I think the U.S. economy is a much stronger economy than the Canadian economy. It's a much more diversified economy. It's an economy that is much more productive. If you look at the productivity level of labor in the U.S. Where it is in Canada, we need that 75-cent dollar to compete, and that hasn't changed. We've gone all in on a segment of the market that is a non-producing asset like real estate for a number of reasons that we just discussed. And so I'm not as bullish on the Canadian economy as the U.S. economy. Having said that, I'm more bullish on Canadian equities versus U.S. equities, again, for some of the reasons that we just discussed. And the TSX, for example, has a much higher weighting to energy, double the weighting than the S&P does. And so I like that. And don't forget, I'm not a perma energy bull. At one point in time, we had like 2 or 3% weighting in energy, And now we're up to 15 to 17% weighting to energy, which is quite significant for a diversified fund manager. And so that's the way we're positioning. I think the Canadian economy is going to have is going to react much quicker to rising rates than the U.S. will, and so that's going to slow things down here.
Martin, earlier you referenced a big shift that you think we're only at the beginning of. What is that big shift, and what does it mean for the investment world?
So you have to ask yourself when there's big structural shifts in the market, and segments of the market, and be willing to question that and be open to it. Because if you don't, it's going to be a world of trouble for you. So, for example, in 2014, I was running an energy hedge fund. It was one of the top hedge funds in Canada for performance. And then the OPEC came in and aggressively targeted U.S. shale, and I said, this is a game changer. So we closed down the fund and gave the money back to investors because it was just not a good place to invest in. And if you're running a long only energy fund and you're not very bearish on energy, well, it's hard to tell people to sell energy when you're trying to raise capital for your fund. And so that was a structural shift. And thank goodness we did that, because it was been awful since then, until more recently. In 2008 was a structural shift. And then what happened following it, quantitative easing. 2000 was a structural shift with the Greenspan and rising rates and the bursting of technology. And I think that what we witnessed in March of 2020 was a huge structural shift. How can you say it wasn't? You had a shutdown of the global economy. And so now we have work from home. We had baby boomers that left the workplace. I'm a huge fan of Charles Goodhart and his book, The Great Demographic Reset, where you had, and Joseph has done some excellent work on this, looking at the labor dynamics. So we had an oversupply of labor, and that was putting, you didn't have a lot of price pressure to raise wages. And now you had baby boomers who accelerated their retirement. Now they're gone. And so now you have 2 jobs for every person looking for a job available. Now, they may not be the best jobs you're looking for, but there's still that kind of availability. And so that's going to put upward pressure on wages. And so there's all kinds of dynamics that are at play here that people are ignoring, saying that we're going back the way it was before.
I agree completely. But one thing I thought was very interesting when I think about Canada and the U.S. is that if you listen to what Chair Powell talking about, they're always talking about labor shortage, and there's the same shortage in Canada as well. But they're doing something very differently in Canada, like we just mentioned earlier. They're importing enormous amounts of immigrants, and that seems like it will likely have some big impacts on inflation going forward, since if you're importing so many people a year, you probably won't have the same level of wage inflation as the U.S., whereas the U.S. is not doing that. So there could be some potential for divergences in monetary policy going forward.
And that's an excellent point. I'm a proponent of immigration, and especially for a country the size of Canada, we need to diversify our workforce. We need to bring some of the innovation that we're witnessing in other jurisdictions. But at the same time, we have to balance it against housing and the shortage of housing. These people need to live somewhere. We need to look at there's severe restrictions on their backgrounds. For example, I was watching on the weekend. There's a young student from Canada who has to go to Scotland to get their medical schooling, and they can't come back to Canada and practice medicine because we won't recognize the education that they had over in Scotland. And so there's some challenges there. And then there's healthcare challenges because we run a public healthcare system. And so with a shortage of doctors and nurses and huge immigration, that's taxing the healthcare system. So it is a really good policy, but you also have to have a plan around these other factors. And so you have to have that balance. And, in my opinion, the U.S. is not doing enough immigration, and Canada is probably doing too much from the services and supporting standpoint. And so how do you find that balance?
We've got a great question. Someone asked on Twitter about this, about the linkage between employment, services demand, and interest rates. They say if the Fed is determined to slow the economy, it must raise unemployment. To do that, it seems we need to destroy demand. So they ask, how high do rates need to go before firms shed workers? So Joseph, my question for you is, how high do rates need to go before the labor market dynamic begins to switch? Or do you think that's an inappropriate question because the Federal Reserve has such a the level of interest rates has very little effect on labor demand, and it's inflected much more by the secular forces that you referenced?
One of the secular forces that we've been mentioning, of course, as Martin mentioned earlier, is that we have an aging workforce. So structurally speaking, the labor supply is either not growing or slightly shrinking as time, depending on the country. I think monetary policy definitely has a big impact on the demand for labor. Let's just think about this for 1 minute. Let's say the Fed raises interest rates to 50%. There's not going to be as much labor demand. Okay, S&P is going to go to 1,000 or something like that. So monetary policy definitely has an impact on that. So whether or not how high the Fed has to go to actually see declines in unemployment, I really don't know. And I think the question, I think what's clear right now is where we are doesn't seem to be high enough. And the reason I say that is because even though we're at almost 5%, we're having gangbuster growth, having gangbuster job growth, and the consumer seems fairly healthy and resilient. So whatever that number is, it seems like where we're at now is not there yet for
No,
constraining the
one thing,
economy.
Joseph, I have a question for you, and it's really interesting. Is and the two factors. One is I'm not sure why central bankers aren't maximizing the impact of their existing rate hikes, and you can see that in housing here in Canada, for example, the restart. Consumer spending in January was just huge, and I read that you have 10 months of spending if they continue at current levels, if they continue to deplete existing savings at the same pace. And so consumers think that they're going to see a rate drop. And then the second aspect too, I'd like to get your thoughts on. Nobody seems to be talking about it, and I look at fiscal and the impact that fiscal has. And to me, that was the catalyst for inflation, was fiscal, because we had a decade of monetary easing and we didn't see that kind of inflationary pressures. I mean, in addition to COVID, obviously, and the big impact there that it had on people leaving the workforce, but fiscal spending, it hasn't been tightened as much as it should be. I mean, we're still running deficits while the central bankers are trying to tighten. Why is there not pushback against that, or is it people not saying that fiscal does not have a relationship with inflation?
Uh, I think discussions on fiscal, in my experience, what I hear on Twitter at least is that you're not giving enough free money to people. So in the U.S., for example, I recently saw a tweet by a governor of the state of New York saying that we should index minimum wage to inflation. And that's
Yeah.
obviously well, it's not well depending on. So that affects the private sector, but I'm sure it also affects the state sector, which has to pay above minimum wage as well. But you also have things like Social Security, where, and because of index adjustments, everyone has 8% more money. So there's more fiscal spending. There's actually a really good report from the Congressional Budget Office, which in the US is one of the authorities that tries to estimate based on current law and some estimate of where the interest rates will be in the future, what the fiscal deficit will be in the coming years. And Martin, I agree completely with you that a lot of the inflation is primarily driven by fiscal spending, specifically deficit spending. So the CBO's projection of the, let's say, at least 5% fiscal deficit for the US is probably an underestimation, because what I've noticed over the past few years is that there's a lot of discussion for the government spending more to do things like the energy transition, but nobody ever talks about, let's say, cutting benefits or cutting down spending. So the fiscal spending is definitely getting out of control here in the US, and that's definitely a source of inflation going forward. Um, what's the situation like in Canada? So many of our readers are US based, so we're not as familiar as the trajectory for the state of Canada.
So in Canada, household debt is like household debt. We look at total debt is the worst in the G7. It's worse than Japan and China, and it's actually worse than Greece. So the level of consumer debt in Canada is quite high, and that's defended by the high asset prices in real estate. And saying, well, it's okay, our asset prices are high, but people tend to forget that when asset prices fall, your debt doesn't fall with it. So, and then actually fiscally, the federal government was not in as rough a shape, not nearly as rough a shape as the consumer household. And then we had the Trudeau government come in and change that quite rapidly. The deficit spending was among the highest in the G7 as a percentage of GDP during the COVID shutdown. And so we're still running very, very large deficits. And so the only safe component of the country was the fiscal situation, and that's being rapidly deteriorated from the existing government. And so the same kind of thought is we need to protect the average person from inflation by giving them money, and that's going to exacerbate and make the situation even worse. And where it gets really interesting, Joseph, I'd like to ask you is, maybe we get a playback of the 70s, for example. It finally puts pressure on these governments as debt servicing costs. And so the debt servicing costs in the U.S. Are going to be quite large, and same in Canada. And so our central bankers going to put pressure. Our government's going to put pressure, the Biden or Trudeau governments. Do you think they can put pressure on these central bankers to really, stop the rate hikes, because it has to put pressure on them to service those debts?
I think, Martin, you bring up a very good point. One thing that's different today compared to the 70s is that the debt to GDP ratio is a lot higher. That means when the central banks hike interest rates, that has a much bigger effect on the deficit because the stock of debt is higher. So when you hike interest rates even a little bit, the interest expense goes up a lot. And as many people have pointed out, that's obviously not sustainable. Let's say, for example, in a few years, we have a debt to GDP of closer to 200%. When you do that, just small increases in the interest rate will increase interest expense significantly and thus make the deficit go even higher. I haven't heard anyone here in the government be concerned about that. I think what happened over the past few decades is that government spent so much and nothing happened. So there's not it's not in the cultural zeitgeist to be concerned about things like this. And also, at the end of the day, they could always have the Fed buy it. So there's never a problem with people not wanting to buy the debt. The constraint, of course, is inflation. So if you have huge amounts of debt, interest expense goes higher, just have the Fed come in and buy it all, then that you are creating even stronger inflationary impulses. So,
Right. And Joseph, so in the wake of the great financial crisis, the US ran what at the time seemed like large fiscal deficits, but they were actually cheap to run because interest rates were, short-term interest rates were at zero and long-term interest rates were at 2.5%. So it was very manageable. Now that's getting a little bit less manageable. So, if this world we are in, let's say, over the next decade, interest rates stay at 5%, or even higher, as some project, how can the federal, not the Federal Reserve, can the U.S. federal government afford that? Will it put pressure on the federal government to make budget cuts? What do you think happens?
the U.S. government can always afford its debt, full stop. Right? If you have a fiat currency system, you have a money printer, you can afford it. If you rewind back 100 years ago when you're under the gold standard, yeah, you can run out of gold. You can definitely not afford it. But when you have a money printer, affordability is never a problem. The problem is always, if you keep doing this, do you create significant inflation, and does that have political implications? So that's one of the reasons why I think significant inflation for the next decade is very likely. The politics today is simply very inflationary. If you think back to what happened during the 70s, Arthur Burns, who was Fed chair then, the story is that he let inflation go out of control. But afterwards, after his tenure as Fed chair, he wrote a speech called The Anguish of Central Banking. And in it, he says that, I could have stopped inflation anytime I wanted. I could have raised interest rates significantly, totally crashed the US economy, and brought inflation under control. But I didn't and I couldn't because the politics of the time was for the government to do all sorts of fiscal things to help the people who did not have a lot of money, just basically to give money to everyone. And the Fed, being part of the federal government, it has to be responsive to the wishes of the elected representatives. And so that was the culture then. And it wasn't until the culture shifted, when people got really sick of high inflation, that we could have a conversation of maybe less fiscal spending and higher interest rates, and endure the pain to get back to less inflationary regime. And today, I think we're very far from that culturally. So I don't see anyone, I don't hear anyone mentioning fiscal restraint or anything like that. So, in terms of the inflation cycle, I think we are probably towards the middle or early innings.
Is there room to, like in Canada, there isn't, to raise taxes? There's no room. Our marginal tax rates are, I mean, when you're over 50%, in some provinces, you're looking at 55%, and then you have a provincial sales tax on top of that and a GST, you're like 60, like, so the numbers are too large. So there isn't the ability to raise taxes in this country. What about the U.S.? Is that a potential avenue that the Biden administration will go down?
So I think the Biden administration has pledged to not increase taxes on anyone making, I think, $450,000 or less. So above that threshold, I think maybe that there is room. And then also, I think President Trump lowered corporate taxes from 28% to lower, like 21%, 22%, 20%. So maybe, I don't know, Joseph.
In the U.S., it's really hard to change the tax code. You need one party to have a tremendous majority in Congress, and that's very difficult to do. So I know the Biden administration obviously wants to raise taxes on the rich, which is everyone who is not them. But that's a hard thing to do, really, in the U.S. So,
well, in Canada, you're classified as rich when you're over $150,000. Like the marginal tax is the threshold is significantly lower. So if you're running, this is why inflation can have a huge impact on the Canadian consumer, because, if you're making 100 grand, and the average house, the single family house in Toronto is 1.2 million. In Vancouver, the average single family house is 2 million. I mean, how can you do that? And you're told that you're at the highest, you're the wealthiest person in the country at 150,000. Well, you don't feel very wealthy when your house is 10 times your income.
That brings up a good point. If we have inflation and everyone's wages continue to go higher, we'll eventually all creep into a higher bracket, and that in effect raises taxes on everyone, right?
Mm-hmm.
So, eventually we'll all be the rich who gets taxed more.
Right. Well, as we approach a close, Martin, I know you wanted to talk about structured notes, which in America are quite rare unless you're an institutional investor, and a lot of people don't know about them. What is a structured note? What is the role of them in non-U.S. countries such as Canada? And then what is the appeal of them, as well as the risk of them? And for the structured note, let's talk about those that are tied to interest rates as well as equity-linked notes.
So when we look at our portfolios, managing our portfolios, everything's a goals-based return. So it'll vary by individual, but most of our clients are probably targeting 6 to 7%. And so we want to minimize the risk level to get there. Obviously, inflation is going to play a role in our returns and our goals and those sorts of things. But having said that, we want to look at investments that are going to be able to minimize the volatility, have some downside protection, and be able to generate a decent rate of return in this kind of uncertain market environment, so that you don't have to make a bet on interest rates. And portfolio isn't going to perform based on what a Fed's going to do, right? And it gives you a lot of peace of mind. And so one of those investments, and it's actually in our balance fund, it's about 35% of the portfolio. Some newer clients, we can run up to 50%, is in structured notes. And a structured note is a derivative instrument, okay? We traded derivatives for about 10 years. We did an option overlay on top of our portfolios. It became, the taxation of derivatives is very different in Canada than the US, and it could be quite cumbersome and involve redoing your taxes. And so from that standpoint, a structured note wraps it all into one investment product. Now it's an investment product, not unlike a bond. It's actually taxed as a bond in Canada. Okay, and it has the counterparty risk, which can be significant if you're not aware. And there have been some problems in Europe with these notes. The Canadian banks are very safe, as we saw during the '08 situation. The Canadian banks are very well capitalized, very conservative, despite some of the lending concerns on the housing market. They still have maintained their prudence. And we have a whole shadow banking market, which can be a whole different discussion. That means that the Canadian banks are not exposed to the higher risk debt, as they've offloaded that off their balance sheets. And so from a counterparty standpoint, if you're doing Bank of Montreal or National Bank or Royal Bank on the structured note, it's a contractual obligation. So you have to make sure that they fulfill that obligation. So that's a low risk. And so what we mean by that is you enter into that contractual obligation. It can be 5 years, 3, 5, 7 year term on that note. The note will pay you a coupon payment annually, monthly, quarterly, depending on an underlying index, or in some cases, if you want to do it towards interest rates. We've been doing more of the equity component. So we took our fixed income down to 10%, replaced on a 60-40, replaced 30% of our 60-40, 30% in total with structured notes with coupon payments of 8 to 12%, as long as and I'll pay that out monthly, as long as the index doesn't fall more than 30 or 40%, and it's already down 10 or 15 or 20%, depending on which index you're looking at or what segments you're looking at. And so our clients are getting paid monthly an 8 to 12% annualized coupon, as long as the underlying index doesn't fall 30% and stay there for the entire term. And so, yeah, there's ups and downs, but we have a built-in downside put protection involved in the note. And the clients are getting that 8 to 12%. Taxed as income, yes, but still well within their target returns.
Wow, Martin, if you look back at certain trades and analyze their timing, that seems like an excellent trade. You've gotten clients out of long duration US Treasury, 20-year, 30-year Treasury instruments and replaced that fixed income exposure with synthetic structured notes that yield a higher rate that don't have the duration risk. However, those notes do get into trouble because they're basically paying off. There's short volatility that the S&P 500 goes down 30-40%, as you mentioned. And even though it was a bear market for the 60-40 portfolio, worst 60-40 portfolio year on record, I think, and it was bad for stocks and particularly individual stocks, the market, I think the S&P 500 was only down at max like 25%. So so I guess the only way, the real setback of that strategy, Martin, is if the S&P 500 crashes 30 or 40%. So how are you sort of weighing that risk? It's the type of thing that it happens so rarely, but when it does happen, that things can go quite haywire.
So you can do different types of notes. And so we do a monthly auto-callable note. So what we mean by that is, let's say we could do one on the S&P in US dollars that pays almost 9%. It'll pay that monthly as long as the S&P doesn't fall more than 30% and stay there. So what we mean by that is, okay, let's say we did that note today and the S&P crashed 30%. We have another 08 type of word, March of 2020. It has to stay minus 30% for the entire 5 years for you to not get those coupon payments, which I don't think has ever happened. Has that ever happened before? Right?
Stay there for 2 years?
No, but can it stay minus 30 for 5 years?
Oh, yeah. That didn't happen during 2008. Yeah, I mean, it's pretty rare.
Even going back, I don't think it ever has. But there's a tail risk. But so if it goes down minus 29% in 2 months, you get your coupon payment. You keep getting your coupon payment. Keep getting your coupon payment until the end of the year 5, if it makes it there, because they'll have a callable feature in 6 or 12 months. If they're 10% above the par price, they get called away. At the end of year 5, if it's down 25%, you would have got your coupon payments the entire 5 years at 9%, and you get all your money back. If it's down minus 31% at the end of 5 years, you lose 31%, but it would have been offset by all the 9% coupon payments. Much better than an equity position. However, if the market comes roaring back and you have 20% move in the S&P, that's where they'll underperform. They get called away. You'll maybe only get 6 months of coupon payments or 12 months of coupon payments at 9. So you're giving away all of that upside. And so, but most of our clients don't care. We'll have an offsetting 60% position long against that with the 30% in those notes. So we'll get some of that upside participation. So for example, when in the market rocketed in 2021, we participated in like 75% of the upside. And then in 2022, we protected 90% of the downside. And so clients like that. They like knowing that they look up their statement. And like I had a perfect example, I'll leave it with this, is my mom called me, and she called me in the end of December, and I managed her portfolio. They sold all of their real estate, and they're renting for different reasons. They put that money into with me. I put it in structured notes. She called me crying. My mom, is everything okay? She says, I didn't lose any money last year. I'm so happy. And I was a little worried about Christmas dinner. And now I don't have to worry about Christmas dinner. So there's huge value in having those kinds of conversations.
Yes, and needless to say, these are very complex products that, if they should be entered, they should be entered either by professionals such as yourself, Martin, or in consultation with experts. People who are not working 5 times full time should not enter these things by themselves.
100%.
Okay. Well, I have two final questions that one for each of you, but I just want to say, people can find Joseph, your work at fedguy.com. Your book, Central Banking 101, is a must read. And Joseph,
and also I have a new online course on markets that I've had.
You got a new online course, so people can check that out. Joseph, I've met multiple people who said that they bought Central Banking 101, and they've all loved it, found it valuable, as I have. And you're the Chief Investment Officer of Monetary Macro, which is exciting. Martin Pelletier, people can find your work at mpelletier CIO on Twitter, and your work at Wellington Altus Private Counsel. Martin, can you tell us a little bit about the fund you manage? Are you do separately manage accounts? Are you launching a new fund? What's going on with your work?
So we do run SMAs for family offices. So we only have 60 large family offices, significant, that we manage. And then we also run a OM, offering memorandum pool fund for our family office clients and those who want to join up with us. We have a 5-year track record on that, which is outstanding. And so we're looking at taking that to more of a public vehicle. So hopefully we'll get that going in the spring. So please watch out for that, and that'll be available to broader investors.
Great. All right. My final question for you, Joseph, is right now, according to the CME, the market is pricing in a roughly quarter chance, a 25% chance that at the March FOMC meeting, the Federal Reserve hikes by 50 basis points instead of 25. So instead of hiking from 475 to 5, they're going to hike from 475 to 525. How are you? What do you think about that? The fact that the market has gotten that hawkish that quickly, and do you think that the risk of this, or the chance of this happening, is greater than 25%, or has the market got ahead of itself and it's actually less than 25%, probably not going to happen?
Yeah. So as I've been mentioning throughout the year, that it seems like the market was way too optimistic on inflation and way too dovish on what they perceive the Fed to be. So I think that right now, finally, the market is becoming more in line with what the Fed's dot plots are. But about 50 basis points in the next meeting, I think that's very unlikely. So the Fed shifted down from 50 to 25. If they thought that they needed more hikes, they could just add more hikes, more 25 basis point hikes later in the year. I think shifting again from 25 to 50 is probably not necessary, and there's really no reason for that. And an extra month or so doesn't really change too much. So the Fed does things very slowly and very carefully. After signaling very clearly in their last statement that they wanted to shift down to 25, it's very unlikely that they would just change that suddenly. More likely is that the dot plots for March will be higher than they were in December. And during the Fed conference, Powell will also guide towards that. So there'll be more hikes projected, just more 25 basis point hikes rather than just another 50. in my view.
Thank you, Joseph. I tend to agree with you. I think 50 is unlikely, although you never know. Martin, my final question for you is, I don't know enough about Canadian real estate to describe it as a bubble. I have heard it being described as such, but your characterization of the real estate market in Canada, it doesn't seem to, necessarily. It seems to be in parallel with a market that is in a bubble, maybe. Do you think it is in a bubble? Then how do you navigate investing client assets into real estate? As a holistic portfolio, real estate is some percentage. Do you advise clients to sort of, hey, maybe be a little bit careful here?
Yeah, so I don't think the Canadian real estate market is in a bubble. There are periods of euphoria, segments of the market that's euphoric. I mean, I don't know if you guys have been in Vancouver, but it's a pretty awesome place, and everybody wants to live there. And Whistler's right there. It's just a world class destination. And as long as the immigration continues, that'll provide support. I always look at real estate as a non-investment component of your total wealth. And so what I mean by that is, you find a place to live, and if you can afford it, and you can run your long-term mortgage rates at 5%, you can afford 5%, then maybe that's the new mean reversion. I don't know, but if you can afford 5, and it goes down to 2 or 3, whatever, then you're that much ahead and you can pay down your mortgage faster. So, but from an asset class perspective, I look at the private real estate market. There's a lot of private real estate funds in Canada offering private mortgage investment corps, that sort of thing. I'm not a fan of them because there isn't the transparency that I'd like. And also, you don't get the price discovery. And so we had public REITs sell off 30% last year. And then you had the private NAVs of these private mortgage investment corps with no change. And they're being marketed as a low correlation asset class. Well, simply because you're not marked to marketing those assets. And so I was advising people, if you had a private mortgage fund, sell it at NAV and buy a public REIT at a 30%. And owning some real estate in your portfolio is not necessarily a bad thing, especially when it's down 30% or 20%. Now they've come back again. U.S. home builders in the U.S. have done phenomenal. But that's the way I look at it, real estate.
Thanks, Martin. That advice seems wise. And as you know, in the US, it is no different. Public real estate investment trusts are down 30 to 40%, and the privates have not been marked down at all. We'll leave it there. Gentlemen, thank you so much. And thank you, everyone, for watching.
Thank you, Jack. Thank you, Joseph.
Thanks, guys.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.